which we are discussing, that is the currency futures options, and in this question we will also deal with the mark to market concepts. So guys, before I start again, I am asking that my voice is clear.
Yes, sir.
Yes, sir.
Okay, now see, D company is a listed company based in the eurozone which has been expanding recently in its home market and abroad. Because of the amount of business it now has outside the Eurozone, so the D company has recently established a separate treasury department. So from the first paragraph, you must be having a know-how that the D company home currency will be the euro and the other currency will be its foreign currency. We will say, what is that? D company plans to open new manufacturing facilities. D company has contracted to buy the heavy machinery which these facilities require from a supplier in the USA. The heavy machinery is due for delivery in 2 months' time with payment to the US supplier of $11,177,18500 due in a further 3 months' time. So guys, from these two paragraphs, you must be having a know-how that what is going to happen. This company currency, its home currency is the euro and the foreign currency is the dollar, because the company is based in the eurozone and this company has to pay its supplier a foreign currency, that is the dollar. The company treasury department has suggested the company should consider the two derivative products. One is the exchange trade euro futures. Contract size has been given, the 3 months expiry and the 6 month expiry have been given. Now over the counter dollar options were given. Exercise price has been given to you people as dollar per euro, and the call option and the put options have been given. Now the call options data as well as the put option data has been given. The exercise prices have been given. The chief executive officer has questioned the treasury department about the product choices which it has suggested, wondering if there are other possibilities. He has also heard that the company will have to deposit funds into a margin account with a broker for each of the future contracts which it opens. He wants to understand how the balance in a margin account may be adjusted. Over time, and whether the company may have to deposit additional fund as he is worried about the cash flow implications. For the purpose of the explanations to the CEO, use the dollar future hedge described above and an example and assume that the closing settlement prices for the first 2 days of the hedge are as follows. The day one price has been given and the day two price has been given. The contract specification for the euro future contract states that an initial margin of $1325 per contract will be required. The exchange rules require daily top up of the account back to the initial margin. And examiner is saying initial margin and maintenance margin are the same. The tick size on the contract is 0.0001. Assume the D company will not make any withdrawals from the margin account after it has been set up. So I will tell you people in today's class in very detailed that what do you mean by this margin accounts? What is the initial margin? What is the maintenance margin? So just wait and watch. Now, recommend an appropriate hedging strategy for the US dollar cash payments which D company is due to make, deciding the factors which D company board should consider when deciding which hedging method to choose. So in this question, the two hedging methods have been described. One is the exchange traded derivatives that are the futures, and one are the over the counters that are the options. Now, show all relevant calculation, including the number of contracts bought and sold in the exchange traded currency future markets. The B part demonstrate the CEO how the mark to mark process would work for the futures hedge, including discussing the cash flow implications and explaining what will happen if the company fails to maintain the margin account. Include calculation the balance on the margin account on both of the first 2 days of the hedge. So in this calculation, what is happening? Examiner is requiring from you people that you have to give the explanations on the topic of the mark to market as well. We have to define what is the mark to mark process and how this process we are going to apply on this question. Okay. Now, guys, before I start doing the calculations, everyone should keep in your minds that if you people want to pass this paper, if you people want to pass this paper, guys, so one thing which is very, very important, what is that? If you want to pass the AFM, for passing the AFM, nowadays the examiner is testing 50% theory and 50% numericals. Now, what is happening? The students, they are always focusing on these numerical parts. They are only focusing the calculations. The students, they are less focused towards the theory. So this is the main reason the students do not pass this paper. The other reason, whenever the students are writing this theory, they are only producing the generic answers. What do you mean by this generic answer? Mean they are not relating their theory to the question stated until unless you people in your AFM exam, you should relate theory to the scenario given in question. This is very important part, guys. What is happening? First of all, the students, they do not prepare the theory. If they are preparing, they only produce the generic answers They are not relating the theory to the scenarios given in the question. If you have not any capability to relate your theoretical portions to the scenarios given in the question, so you will not get the full marks. So first of all, in your remaining days for the exam, please make sure that you are working accordingly. And I will solve the question on the whiteboard because I have to give you people the maximum explanations. And after the class, I will share the spreadsheet answers with you people as well. So everyone, it is my request to open the question that has been shared with you people in the groups. We are solving the Darmsden Company, September 24 pre-mock exam. And please guys try to participate. Just give me 1 minute. Now, as examiner was asking you people to apply the futures, guys, remember, if you will follow my step-by-step approach, whatever the question the examiner will give you, you can easily solve that question. Now, what is that step-by-step approach? Whenever you have to solve the future question, first of all, you will state here the amount of the foreign currency. So guys, how much amount was we have to pay in the dollars? That was dollar 777,18500. In this question, the D company is based in the Eurozone and this company home currency is the euro and this company has to pay dollar. So dollar is the foreign currency, euro is the home currency. Now guys, the second step, which is most of the time the confusing step for the students. Sir, how we will decide whether we will buy future or sell future? This is the most confusing point for many of the students. Guys, see, this buy or sell criteria, this depends upon the contract size currency. Can anyone in the class tell me what is the contract size given in this question? What was the contract size? The contract size was given in this question as euros 125,000. Now, what will happen, guys? We are in the euro. The D company is in the eurozone. And the D company has to pay dollars. So what criteria the D company will opt? As the D company is in the eurozone, so D company will sell euros and D company will buy dollars because the dollars the D company has to pay. So guys, I told you people that this buy or sell criteria depends upon the contract size currency. In this example, the contract size currency was euro. So what you are doing? You are buying the euro or selling the euro? We are selling the euro. So you will tell the examiner that in this question, we will say we will sell future. And now, which future? The payment. Payment we have to make after 4. Now the rule is the future we will select that is immediately expiring after transaction date. That is immediately expiring after transaction date. Now guys, as we have to do the payment after 4 months, in the question, the examiner has given you the 2 expiries. One is the 3 months expiry and one is the 6 months expiry. So, according to the rule stated, immediately expiring after transaction date, as we have to do the transaction after 4 months. So, definitely after 4 months, we will go for the 6 months futures. So, you will say sell future 6 months price. What is the price given, guys? 1.1229. And the currency denominations are given to you as dollar per euro. Any issue to anyone up to this point, please raise your hands. Anyone in the class
How you got the
who
4
still
months,
do
sir?
not know how we are selecting the buy or sell or how we are selecting the 6 months future?
How you got the 4 months, 4 months, sir? 4 months.
Okay, everyone clear?
How you got the 4 months? The 4 months. Hello, sir.
See, guys, again, it cannot be 3 months. The rule is which is immediately expiring after transaction date. So if you are going to do the transaction after 4 months, so 4 months, definitely the coming after the 4 months, the 6 months. You cannot state the 3 months, that will be wrong. And this buy or sell criteria depends upon the contract size currency. If you are buying contract size currency, it will be a buy future. If you are selling contract size currency, it will be a sell future. Like if we apply this criteria here, what will happen? As the D company is in the Eurozone and the D company has to pay the dollars. So D company will go to the bank, D company will sell the euro and buy the dollars because the dollars the D company has to pay to a foreign supplier. So our contract size currency was the euro. As euro we are selling, so we will say we will sell future because always the criteria depends upon the contract size currency. If I modify this, I say to you people, the contract size currency was given to you people the dollar 125000. then you bought the dollar, then it will be a buy future. Whatever you are doing with the contract size currency, that will be your buy or sell. Now, guys, the price which you select.
Yes, sir. Sorry, how is it
This
4 months,
price
sir? 4
is
months.
always known as the opening future price. Examiner never gives you people the closing future price. Exceptional case was there in your past papers. The question name as the Frongoch company. In the Frongoch company, the examiner had also provided you people the closing price as well, because examiner was demanding from you people that you people have to tell the examiner that whether actually the basis risk occurs or not. That was another scenario. But in this question, only the opening future price is given. Yes, Miss Rafia, tell me, what is your issue?
Sir,
Miss
how did you
Rafia,
arrive at 4
you are
months?
asking something?
Hello? Hello?
Yes, Miss Rafia.
How did you arrive at 4 months?
Okay, maybe I am wrong. When, what was, when we have to pay to the customer?
I think it should be 5 months.
Oh, no, it was, sorry, it was a 3 months. It was given in the question. See, guys, this is delivery in 2 months' time with the payment to supplier you in further 3 months' time. So if we take this as well, now see, more clarity if you people see now. If we make it more clear, we are saying that delivery after 2 months and further 3 months to pay. So it's mean that effectively there are the 5 months there. Five months for payment. So if there's a 5 months for payment, guys, so definitely immediately expiring is the 6 months. You cannot select the 3 months price. Now more clear? I was just getting here the 4 months. So even after the 4, we have to select the 6 months. But the more clarity is that examiner told you that delivery will be after 2 months and then further 3 months to pay. So it's mean that effectively we are going to pay to our supplier after 5 months. So if the payments have to be made after 5 months, so definitely the 6 month future we will select. Now clear, Miss Rafia?
Yes, sir.
Now see, guys, this is the opening future price. Now what will happen? These futures are the binding contracts. If we have opened a future contract, we have to close it as well. But the opening future price was given. Examiner has not given us the closing future price. So remember, guys, if in the question of the currency closing future price not given, always fall with the lock-in rate. That is very important point, because in the interest rate question, when the closing future price will not given, we will compute that. But in the case of the currency question, when the closing future price is not given, you will solve the question with the lock-in rate. Now, what is the formula for the lock-in rate? Lock-in rate formula is opening future plus minus remaining basis, but in opposite direction. There are the two formulas for the calculation of the remaining basis. So if you will just follow mine formula, that will be okay. The opening future we have already selected 1.1229. Now we have to compute the remaining basis. Remaining basis formula, opening spot minus opening future. Guys, what is the current spot rate that has been given to you people in this question? Can anyone tell me? Tell
One
me, guys.
point double one double nine.
1 point.
Double one double nine.
Well done. This was given 1.1199. And the future 1.1229. Now see, whenever you people are computing the remaining basis, always mention the dates. Like in this question, the months have been given. So state here the first month. And the future we have selected for the 6th. So guys, when we have to pay to our supplier, what was that? Payment after 5 months. So take the difference. Ignore the minus. What is the coming? 0.0030. Now divide by the total months. The total months are 6. And as we have to pay our supplier after 5 months, but we have selected the future for 6 months expiry. So it means that there is still 1 month left. So how many remaining bases are coming? 0.0005. What is the lock-in rate coming? Oh, sorry, the remaining basis? 0.0005. Now, how we will decide whether we will add or less? Check the trend. from first month to 6 months. It is 1.11 to 1.12. It is increasing, but we have to go into the opposite direction. So we will less it. So your lock-in rate is coming 0.0005. What is your lock-in rate coming? 1.1224, and the currency denominations will be dollar per euro. Any issue, guys, to anyone? Please raise your hands. Hurry up. In the calculation of the lock-in rate. Hurry up, guys. Any issue? Everyone clear? Please participate, guys. These sessions are just for you. Neola, are you in the class? Miss Neola.
Yes, sir.
Okay, are you clear?
Hello? Yeah, yes, sir.
Okay, now guys, what you will do, again, one point I am discussing now. If in the question, examiner says, go for over or under hegemony, then there will be an other step. Otherwise, convert foreign currency at lock-in. As in this question, there was no calculation for over or under hedging. So just you will tell the examiner that the last step, that will be the expected payment. How much that will be? We have to pay the dollars 77,18500, and the lock-in rate is $1.1224 per euro. So divide by this rate. 1.22, sorry, 1 point, how much? 1.1224. 1.1224 dollar over euro. This is canceling. So how much your expected payments, guys, in the euro? How much?
$687,7049.
687
7049.
687
7049.
No. Anyone else?
6876782.
6876782.
6876782. Yes.
So this was your currency future. Now we have to solve the option. But remember, very good point. In this question, normally what happens, the examiner tests from you people the currency futures and the currency options. But in this question, what was happening? The futures were the exchange traded, but the options were the over-the-counter dollar options. These were the exchange traded euro futures, but now it is the over-the-counter dollar option. Now, remember, what is going to happen? Yes, Edwin, very good point, brother. We can or we must compute the number of contracts as well. Like the number of contracts, guys, we forgot here. After this price, there should be the number of contracts as well. The number of contracts formula is amount of foreign currency, that is 77,18500 divided by contract size. The contract size was given to you people as euro 125,000. But see, the currencies are not same. If this happens, you will first divide this with the opening future price, that is $1.1229 over euro. So you will get the number of contracts, that will be 54.99, or you can say almost 55 contracts. Okay. Now, in the case of the options, what will happen? First of all, try to understand. In this question, examiner has provided you the OTC options. If these are the OTC options, mean here no contract with any exchange. And these options have been given you the dollar options. So you will tell the examiner, as we have to pay the dollars, as dollar payment we have to make in the 5 months time, and we have been offered the dollar option. So we will, as we have to pay the dollars, so we will buy dollars. We will buy dollars. Again, I am explaining here, the buy or sell criteria will not depend upon the contract size currency, because it is not a exchange traded option. This is over the counter option. You have to see that we have been provided the dollar options. We have to pay dollars. As we are in the Eurozone, what we will do? We will buy dollars. If you are buying dollars, this will be a which option, guys? Call option. Again, see in the question. First, we said this is a call option. Now, guys, the 2 months expiry is not possible. Only the 5 months expiry. The 2 month expiry you cannot take. First of all, we said that out of the call option or put option, which option is valid? As we have been offered the dollar options, so we have to pay the dollars. What we will do? We will buy the dollars. That's why call option mean right to buy. We will say the call option. Now, the 5 months expiry. Do not select the 2 months. That is not possible. Because the payment you have to do in 5 months time. Now, you will tell the examiner, this is the call option and the 5 months. Now, guys, what will be the payment? 7718500. What was the exercise price given in this question, guys? What was the exercise price? The first exercise price. What was that? Tell me. 1.1225. And the currency denominations are dollar per year. Now, as we have to pay this, so this divided by 1.1225 dollar per year. Dollar cancelling. How much will be your payment? 6868. How much? 6876,169. But as this is an option, guys, on the option you have to pay the premium. What was the premium cost, guys? Guys, what was the premium? Can anyone tell me?
112500.
The 5 months expiry premium was given in this question. How much was that?
112500.
And that was 1125.
2500.
Now, this premium cost was given to you in which currency? In the dollars or euro? Tell me, guys.
Dollars.
In dollars.
So convert this into your home currency. But remember, always the premium cost is being paid in advance. So for the conversion, always use the current spot. So what was the current spot that was given to you people in this question? 1.1199. So dollar 1.1199 dollar per euro. So how much is the premium?
100,455.
And what will be the total payment? Add these both. 69 76 624. This computation was on the exercise price of 1.1225. Now in this question, there was an other exercise price given. The second exercise price was how much? $1.1175 per euro. What will be the payment, guys? So $7718500 divide by $1.1175 over euro. How much will be the payment? In the euro, 69,06935. Again, premium. How much was the premium in this? $92,000. Again, convert it. 1.1199 dollar over euro. So it will be giving 82150. And the total 69,89085. Because it was over the counter option, there will be no calculation of the number of contracts. There will be no calculation of that premium cost, which was the previous formula, number of contracts into contract size into premium in cents, because it is not exchange traded option. It is over the counter option. Now, guys, when you have gone through this calculation, the discussion part is very, very important. In the discussion part, first of all, compare. See, under the future contracts, the payment is 6876. Here, 6969. First of all, you will tell the examiner using future that the company using future mean the company will pay less than the options contract. But tell the examiner using the future, we have ignored transaction cost. We have ignored margin requirements. You will tell the examiner, while calculating the future, we have computed the basis risk. And in this question, we are assuming that the basis will diminish to 0 at a constant rate. As the basis was coming as how much? 0.0005. So we are saying that the remaining basis, which is 0.0005, that will be diminished. That will be gone to 0 in 1 month's time. But this may not happen actually. The basis risk, we are assuming it will diminish to 0. But this may not happen actually in reality. If this will not happen, our actual results will deviate. Now, if we compare the two options, one is the 1.225 and the other one was the 1.1175. You will tell the examiner the options contract with a price of this gives a lower payment. You can see 6976, this is 6989. Now, beside that, you should tell the examiner these two options are over the counter options. Demons or the D company might also consider using traded options. Because you will tell the examiner if the D company is using the traded options, it will be giving this company price transparency, less risk of default because the exchange is involved. Under this exchange traded options, what will happen? You will be having the standardized contracts. And these exchange traded options, they will be available
So
in,
I have a question.
yeah,
I have a question on the selection of calls, because originally if in the real world we are selling futures, it means we buy puts, right? But
brother,
how
I
this
already told that it is a over the counter option. It is not an exchange traded option. So do not relate this option with that of the futures. The futures contract were the exchange traded and they were given to you in the euros. This is examiner already told you that the dollar options have been given. So we have to pay the dollars. So what will happen? We will buy them. That's why it will be a call option. And if you want to more do on this question, like this. So you should, everyone, try a question in your past papers and name as the founder company. The founder company was also a very good question on the topic of the OTC options. Understand?
Okay. So from the question, how do I get that this is an exchange traded option or it's
It has
it's
been
an
given
OTC option?
whether any contract size was given for the options. Tell.
Yes.
How it is you are saying that this is given. See where it is given. Examiner already told you over the counter dollar option. That's it. Okay. Now, so out of these choices available, you will tell the examiner that the futures will be the best choice available. Now the B part of the question, which was the mark to mark market. Guys, examiner told you about the initial margin. Initial margin, you should understand like a way that if you are going to open a future contract, so you have to deposit some initial as we open a bank account. So the bank is requiring from you people to deposit some initial amount. So examiner told you that the initial margin was how much? How much was that? $1325 per contract. And the number of contracts, 55. So the total initial margin was 72875. Now, guys, try to understand, everyone. The exchange houses, they are requiring from you people to deposit some initial margin as well as the maintenance margin. In this example, the examiner told you that the initial margin is equivalent to the maintenance margin. They both have the 72,875 level. What will happen? For example, if you have made a profit on the first day of trading, that will be added to the margin account balance. But for example, you have made a loss. That loss will be subtracted from this balance and your margin balance will be going down. When the margin balance is going down from 72875, you will receive a call from your clearing house that is known as a margin call. Why they are calling? They are requiring you people to deposit again so that the loss which have wiped out your initial margin from 72875, now it is lower. Whatever the lower amount is, the call they are going to make you so that you can again top up and your amount can go to 72875 again. Now,
Okay, bye.
what is happening at the day one?
Okay.
At the day one, what was your price? We said that we will sell future at which price? 1.229. What we said? We will sell future at 1.1229, and examiner told you that the settlement price or the buy future will be at which price, guys? 1.1247. So guys, whether this is a gain or loss? we sell at this price and we are buying at a higher price. It will be a loss. How much loss? Now, one important thing in the currency questions, if you have to compute the total gain or loss, so the formula is gain or loss in ticks into tick value into number of contracts. Now, first of all, how you will convert this loss into the ticks? You will state this loss 0.0018 divide by the tick size given. In this question, the tick size was given 0.0001. This loss will be converted into the ticks. In this question, what was the tick value, guys? Was this given in the question or not? If not, the tick value is having a formula contract size into 0.0001. The contract size was how much? Euro 125,000 into 0.0001. What is the tick value coming? Tell me. Hurry up, guys, hurry up. What is the tick value? $12.5. This we will place here. Number of contracts 55. So our total loss will be how much, guys? Tell me. One, 2, 3, 7, 5. It's mean that what will happen? This margin will be reduced by this loss amount 1, 2, 3, 7, 5. So what is the balance? This one, but this is day first. Now on the day second, what is going to happen? You will tell the examiner the previous price was how much? 1.1247. Price was how much? 1.1247. And what was the closing price? 1.1236. So if this was a buy, guys, this was the price of day one. This is the price of day two. Now tell me, guys, this is a gain or loss? Tell me. Tell me, guys. Gain. How much?
0.0011.
Now convert this into the total gain. So 0.0011 divided by 0.0001. The tick value we have already computed and the number of contracts are 55. So the gain will be 7563.
Two.
Now you will tell the examiner that again this gain will be added in margin account. Now, if you have to give the more explanation, you will tell the examiner that when this was a loss of 12375, this have reduced our margin from here to here. What will happen? On the first day, we have to deposit extra. Again, 12375. You will receive a call from your clearing house. They are requiring you people to deposit again 12375 so that your margin account balance from 60500, it will be again top up to 72875. This call is known as margin call, and the balance you are paying, that is known as the variation margin. On the second day, this was a profit. This will be added to the margin account balance, and the profit you can withdraw in the form of the cash as well. So this was all about your first question.